Good afternoon to all of you and welcome to the show. Today our topic is market outlook and investment strategies. And we are pleased to have with us our guest today, and he is Mr. George H. Joseph, and he is the CEO and CIO with ITI Mutual Fund, and he's having a lot of experience, and I'm sure that we are all going to benefit out of it. And he's to give you a brief background about him. He is a chartered accountant by qualification and also a cost accountant, and he's having long experience with ICICI Pru Mutual Fund and with DSP and with Aditya Birla and many others. And last stint of his was with ICICI Pru Mutual Fund, where he was managing 10,000 crores of funds. So the kind of fund he was managing was from multi-cap to small cap to investing into thematic ideas and whatnot. So he's having a vast experience in that sense, and I'm sure that we are all going to benefit with the kind of experience he's holding. And so we'll be starting. And before that, thank you so much, Mr. George, for joining and accepting our Zoom conference. And
thank you, Paras, and nice to interact with you on Zoom.
Yeah, last time we interacted, that was a fabulous interaction. I remember that in our monthly insight, we took your interview, and a couple of themes and ideas you talked about last time was really, really very good. And to talk about one thing which I remember still now, that is the pharma bet. You were talking about pharma at that point in time, that 11 to 12% kind of growth can easily be achieved as a compounding return in pharma sector. And after that, the fiasco of COVID-19 and whatnot has happened. And now we are seeing that pharma is the most sought after sector, and people are holding their breath on to hold on to pharma sector and thinking of gaining further from here. So that's a topic we will discuss as the conference progresses. Before that, briefly, I'll touch upon our Ashika group. So we are a quarter of a century old financial house, and we have deep experience in the financial domain, whether be it retail broking, where we have almost 1 lakh clients, whether we are into institution empanelment, where we have almost serving to more than 100 institutions and serving to more than 100 family offices as well. We are into investment banking, we are into wealth management, NBFCs and whatnot. And the most important thing is that we are a pan-India broking house, broking outfit, and a financial house with having deep penetration in the eastern region. And to tell you that for Ashika Group, we have won awards and accolades in best DP from NSDL and highest DP from NSDL, CDSL, and the best broking in the eastern region from NSE as well. So these are what are the brief awards and accolades of ours as well. So that's how I wanted to describe Ashika. And now let's get on to the Q&A series. The format of the show is going to be Q&A. And after that, we'll taking up a couple of APs as well. Our channel partners will be asking questions, and also a couple of investors as well. So let's start. First of all, now, as we are seeing that the finance minister is coming every day and announcing stimulus package to boost the economy. And we have a lot of questions. Some of them are talking pro about the stimulus, and some of them are talking that the stimulus is not going to stimulate the economy the way we are thinking of. So there are a lot of ifs and buts, but who is none other than Mr. George, who is going to dissect everything for us as far as the market is concerned, as far as the stimulus is concerned, and help us. So the first question goes this way, that for the SME and MSME, they have done a big thing. And a big thing in the sense that 3 lakh crores of package which has been announced for the SMEs and SMEs. And we all know that this is the backbone of India, wherein 12 crore SMEs are there. And if we talk about 4 and 5 people as families, then almost 50 to 60 crore people are affected as far as SME and MSME are concerned. And out of that, if you look at the contribution in GDP, it is to the extent of 29%. And the export contribution is to the extent of 50%. So almost $800 billion of output is there with SME and MSME. Government is taking cognizance of the fact, and we all know about it. So how do you read that 3 lakh crore is going to stimulate, or what all are the other measures, and how do you see that the backbone which is of Indian economy is going to get revived with the kind of stimulus package which the government has given?
Thanks, Paras, for the introduction as well as inviting me for this discussion. First and foremost is that your government has done a fabulous measures in the last a few weeks, and it started off pre-COVID also. Some of the measures which they have taken from 2016, people might uh, have apprehensions about it. Either demonetization, GST, real estate act, and various other measures, and even the tax cuts which they've come up with. It is timely measures which they've taken. But nevertheless, when you are taking some structural reforms, obviously it will have repercussions on the growth in the near term, and that is what we were facing since 2016. Um, at the time when the economy is about to recover, we faced the COVID-19 impact, and that has created the lull factor at this moment. To cover up these issues, government has come up with, and RBI has also come up with almost 6 lakh crores of liquidity arrangement, and government has come up with so much of liquidity as well as some fiscal boost. The kind of fiscal boost which I was expecting was much more than what was given. It is around 1 lakh crores is the total fiscal stimulus, if I may say. But direct benefit transfer could have been considered, to the hands of the people, common people, so that there is a little bit more consumption demand also picks up alongside the measures which government has announced is good enough to take care of the economic recovery. Even government doesn't do anything. My belief is that the India is in such a nice sweet spot. The economy will automatically recover as the time progresses. And in a year's time, people will be talking about the high growth rates rather than, talking about the low growth rates, right? So I am very, very optimistic Indian, and I believe that, there are various number of, quite number of good entrepreneurs in the country, as well as the kind of growth which we are going to see 1 year from now, or, maybe 9 months from now, we will be unprecedented. The same situation what we are facing right now, the unprecedented situation of COVID, and people are sitting at home and not doing any work, and we think that India is doomed and it is not going to work, but that is not going to be the situation. So I think government has done fair bit of it, and RBI has done fair bit of it. Maybe a little bit more fiscal boost, if it had been given to the economy, it would have been much better. So that's all I would say. Nevertheless, there are constraints for the government also. Now, 3 lakh crores, what you mentioned, is the credit guarantee which government is giving towards MSME segment. As you rightly pointed out, the MSME is a heart of the economy. There are almost 60 million MSMEs to put it in perspective. If these 60 million MSMEs are not recovering, then obviously the growth will be significantly at trouble. So if you think that 5 trillion economy which Modi is talking about, if he wants to reach there, obviously this is the segment which has to be definitely recouped. So 3 lakh crores credit guarantee is very, very good. But alongside, to spur the demand, there is a requirement of some fiscal boost. I think, as time progresses, government will look at doing that. Maybe they are constrained about the fiscal deficit situation, but I think this is an unprecedented situation where they have to come up with some unprecedented measures also. Because you cannot be looking at a fiscal deficit situation at this point in time, rather than the economy recovering is the most important factor which needs to be considered. If it doesn't recover, the fiscal deficit anyway is going to go for a toss, right? So that is something needs to be looked at.
Okay, so when we talk about fiscal deficit, at present, what is happening is that what the investors and all the market participants and think tanks are talking about is that the fiscal deficit or whatever the government is giving, more it is trying to give in terms of loans and credit guarantees and whatnot. And that is all going to get channelized through banks. So in such a scenario, what do you think about the financials? They already are in a lot of strain. and a lot of pain, and people are expecting that a lot of NPAs are going to pile up because of it, and there is going to be a lot of stress. How do you see the banking space or the financial space going to cope up with it? And what do you see the future of financial space at present from here on, considering the fact that the poster boy of yesterday was the financials who drove the market or the last bull market, and the financials gave huge return to investors in last couple of so many years? So what do you have a take on it from here on?
So, it is a very interesting topic. I don't know whether you remember it when we had the last chat. I was mentioning that, 42%, 43% weightage in the Sensex.
Absolutely. Yeah.
Banking sector is not sustainable. And, that is, there is a very high weightage for, if you compare to 2008, it was less than 20%. And, it has just doubled in the last 10 years period, 10, 12 years period. So this kind of weightage is not sustainable for any sector. And globally also, when you see many sectors like this, in the index composition, if you look at, the sectors which have gone up significantly, or, the weightage has gone up substantially over a period of time, those sectors will take a backseat in the next cycle. If you have seen the 1990 to 2000, technology was a booming sector. And 1990 to 2000 to 2010, the entire infrastructure was a booming sector. And 2010 to 20, consumer has been a booming sector, right? So my belief is that, and plus the retail banks, consumer plus retail banks. If anything connected with the consumer, the companies, the stocks, the price to earnings multiple or price to book multiple, everything has increased substantially in the last 10 years. So that's why all the FMCG pack, retail banking pack, retail NBFCs, they have grown significantly, and the valuations also went through the roof. I think those will take a backseat, as we move forward, especially from the valuation point of view. Ultimately, when the economy recovers, the financials also have to recover, because they are the bread and butter for when the economy recovers, the banking system recovers, and obviously the recoveries for the financial system also recovers, and there will be a significant boom in the economic recovery when it happens in the financial system also. But the valuations may not go to the same rooftop levels which we have seen earlier. Coming to the situations where currently we are in, I think the financial sector is going to reel with a lot of NPAs. But the government, I think RBI has to come with some more very, very strong measures to, combat the COVID impact in terms of forbearance clauses. That whatever, it is very simple. If you think whatever NPAs were there as of or whichever loans were standard as of 31st Jan, it stands to be standard even on 30th September. So as simple as that, they have to come with a forbearance clause. I think, it will put the small borrowers' balance sheets in order, and also the rating agencies will not downgrade them significantly, and therefore the banks also will be able to lend to them, and then for the demand recovery will be faster. So that forbearance clause is something which I was expecting coming from RBI, but not yet happened yet. Moratorium is only a very stopgap arrangement, which is not at all changing the scenario for the rating downgrades. So I would say that financial services space as it stands today, obviously it will have the most impacting sector, but I don't see them going back to the same valuation scenario which was there pre-COVID.
Okay. So now the next question is with regard to other important sector of the economy is agriculture, and the government is announcing a couple of measures as well for the agriculture sector as well. So if we look at the dynamics of the agriculture here in India, we have 14 crore families out of 25 crore families we have here in India at present. So that is a large section of the economy. And at present in COVID scenario as well, if we dissect the economy and look at the support system of Indian economy, then agriculture has come to the forefront, and the basic necessities is what the food is which is required. So agriculture has come as a steady state for the Indian economy. Add to it the healthcare sector, the power sector, and the data, that is the telecom. So these are the couple of sectors, broad sectors, which has supported the backbone of Indian economy at present. And we have come to the understanding that that at present, because of these all sectors which are bare essentials, and add to it the consumer staples as well, they have supported big time in this lockdown phase. So how do you read these all sectors? Are these sectors are going to become more prominent as the lifestyle changes, and probably the discretionary spend comes down for the people, and with lower income and lower employment, what is the trend you see emerging out of these all things, where some of the sectors are shining prominently at present?
Yeah, so obviously the sectors which have been benefited out of this lockdown period is maybe technology led any companies which are providing entertainment, uh, Netflix and Amazon and all these companies have been providing the entertainment to people who are sitting at home. So that has been, if you see Spotify, the revenues have grown significantly, and we have seen that across globe, all these companies which are providing entertainment or technology-enabled services, they have been doing very well. Uh, what we have seen in the recent past is that telecom as a sector or FMCG as a sector has been, doing very well. And telecom for the right reasons, because last 10 years the sector was under severe stress, and it was a highly fragmented sector. While I was in my previous company in ICICI Prudential Mutual Fund, always the discussion we used to have at the boardroom sessions used to be that when the sector is going to revive. And I always used to be very negative about this sector for almost more than 10 years. But I have turned bullish last year, mainly because there are only two companies in the sector uh, who are very, very relevant, Reliance and Bharti, and the third one is Vodafone. So there are only three companies left. So as per Porter's model, when the competition comes down, obviously the sector benefits a lot, and the pricing power slowly improves. And that's what we are seeing in that sector. So it is a multi-year story in that regard, according to me. And there are companies within that also, changing their gears and moving more into entertainment, and not only be a telecom company, but looking around the telecom as an enabler and providing services, which can be very, very, very nice. So therefore, their growth prospects also can increase substantially over a period of time. When it comes to FMCG, their valuations of these companies are the only issue. Otherwise, the companies are great. What I learned over the last 30 years of investing is that for us, you have to, respect valuations. You have to respect business cycles. What has happened in the last, as I mentioned, when technology went out of favor, it has, you would not believe, last 20 years, that is 2000 to 2020, Infosys kind of company which has grown in size, the cash pile has increased, the stock has underperformed the Sensex by miles, right, for 20 years. So it is not a joke. If you had invested in 2000, you don't need to, you would not have made money even today, compared to relative to the index or Wipro or any technology stocks. And many stocks have gone completely belly up also, like Pentafor Software and various companies are not existing assets. So what you would remember is that, or for example, infra in 2007, if you had invested, the last 10 years, 12 years, you would have been sitting on a huge pile of losses, right? So there were a lot of infra funds which came in 2007, and none of them are doing that great at this point in time, because even the best company in that sector, like L&T, has not generated more than 6% return CAGR since 2008. So which means that you would have been better off being in FD, right? So sectors go through significant bull market, and the valuation stretches significantly related to their growth. Ultimately market has to grow. The market valuations have to grow in tandem to the earnings growth the company is at. What happens is that when the earnings growth is visible, people, there will be a herd mentality. People come in and take the sectors to a different level altogether. So it's like a pendulum. When the valuations move up significantly, and then later on the valuation moved down also significantly. Today, for example, infra stocks are trading ridiculously cheap. Nobody wants to look at it at this point in time. 12 years significant underperformance. So sectors goes through these cycles. Valuations go through cycles, as well as the businesses also go through cycles. Like pharma, for example, as you rightly pointed out in the beginning, last 5 years, the sector is going through a tough time. There is a lot of issues with regard to FDA. There is a lot of issues with regard to the non-approvals from US, and various challenges. And in India also, the NLEM which came in also has hit them hard. All those were going against them. The business cycle was completely bad, but doesn't mean that the companies are bad, right? So the companies have been existing for 20 years and they have been generating cash. So that is the situation we are in. And I think FMCG, the valuation derating has already started. If you see last 1 month, you would be surprised, which is the best performing stock. The best performing stock was Reliance in Sensex, and the worst performing stock was, HUL. So it would be very, very surprising to see that, the market start looking at recovery. To answer your question specifically, I took a little bit longer answer, but I would say that, the next 1 year, 2 year, 3 years, you have to play for recovery. And my belief is that when economy recovers, obviously discretionary spending will recover much faster than the staple spending, and that is where the biggest opportunity also lies. Be it construction, be it real estate, all of them will recover. Maybe they are real estate will be a late cycle recovery, or infrastructure will be a late cycle recovery. But early cycle recoveries will be like auto ancillaries, and all these sectors which are anyways going through a significant downturn, like 20-year low growth rates these sectors are going. So how much more you need to expect to go down? So I believe that there will be a significant, we are at the bottom of the economic cycle. From here, when it rebounds, I think the FMCG and some of these sectors which have been doing well today will take a back seat, and the recovery sectors will take a full throttle growth will be visible.
So to extend the same the question, I can understand from the fact that perception is bigger than reality, and it is the expansion in multiples which leads higher returns for any particular sector, and coupled with it the tailwinds at that point in time and the expectations which are building up there. So now to extend it, what do you see are the tailwinds for sectors which are going to perform from here? And are there new sectors which are going to emerge once the new cycle resumes and the upswing resumes or the bull market happens? Or do you see that the age-old sectors wherein like infrastructure, where the capital misallocation has been a big question, or the companies which are not showing growth, how should one investor position himself at this point in time, considering the fact that it's going to be a bull market which is going to be led by new sectors and new themes, or maybe the older sectors where the profit pool probably is going to jump up quite significantly?
So I strongly believe that when economy is going to recover, it is a specific, very, very unprecedented crisis which we are facing right now. And this kind of crisis we have not seen, apart from the Spanish flu kind of environment, where we all were not part of that situation. So, every time when the crisis happens, it will happen. It starts at a point in time and it ends also. Today, there is no visibility of ending, and people are really panicking. But ultimately, it is going to end. And my belief is that when we look at 2008 crisis, in 2007, all the infrastructure sectors were doing extremely well. And then when the cycle turned, and when the market tanked, and when the next cycle started, the sectors which led the rally were retail banks and all these. But at the same time, the sectors like consumer and pharma, which were not doing well during the entire 2003 to 7 period, which were significant underperformers, started doing very well. So every time when the cycle turns, when a post-crisis situation, the sectors which will start doing well will be very different compared to what you and me thinking at this point in time. And my belief is that pharma has started the rally, and that is going to take steam. You can see the silver lining over there, and you can see the tailwinds clearly visible because one, the approval rates have increased. Secondly, the facilities which were under trouble with FDA problems, which is now coming to an end, and most of the facilities of various companies, be it Lupins and Pharma, all the majors have got resolved, and they will start getting the approvals faster. So it is a simple process that if you get the facility approval, you will start getting all the filings done from that facility. Also, the approval starts, and then you can launch those products. So I think the cycle has started in their favor, and maybe pharma is going to lead the pack, is what I believe. Secondly, if you look at the sectors which are directly impacted because of the COVID-19, a lot of sectors will completely go out of favor, and you will not come back also. Like say, for example, uh, you know, uh, like movies and those the theater industry. I think those sectors can actually find a very difficult scenario not to come back into normalcy, because it will take time people to get adjusted. And the initial feedback from China also is that there is no recovery in the movie theater space. Whereas the discretionary spending, be it auto ancillary, consumer spending, home improvement, very specifically, because you are spending more time in home. For home improvement segment, you are going to see significant uh, pent-up demand coming through as the post-COVID scenario. So I believe that uh, early cycle recovery plays, and especially the auto ancillaries, I would put in that bucket. Pharma specifically, I think the cycle is turning and maybe lead the rally, and it is already showing up. And you will see the construction sectors, as the government capex picks up, and all the migrant workers have to be taken into consideration. And some of the package 3 is more towards the farmers and agriculture. I believe that there will be more impetus on the rural segment also. For rural exposed sectors, and pharma and auto ancillaries and construction. So this is the way I will look at to play the recovery. And maybe a year later, maybe or when we reach May 2021, when the visibility of the recovery is clearly in place, maybe I will look at the infrastructure sectors as well as the real estate sector to play. I think all these sectors, consumer discretionary, the low ticket items will start looking up faster, followed by the large ticket items. I think we are going to see a massive recovery a year from now.
Okay. So that's a very optimistic note. And now the second, coming back to the current situation at present, when we talk about that demand recovery or the pent up demand is going to shoot up. And so now the situation at present at the ground level is that manufacturing businesses, and when the lockdown steadily gets unlocked, and the manufacturing sector is facing a lot of trouble with regards to labor, and there is a lot of debate going on that labor who has gone back to home is going to take time to come back. At this point in time, at a stage when companies from the zero level is trying to now open up, and with labor shortages, what is it, how is it going to get fixed up, and how do you see things unwinding from here on with the manufacturing sector at present, where the capacity utilizations are say at around 20% because of labor shortages and whatnot, and how demand is going to be there for sectors as well?
Yeah, I agree. This is a very valid point. I think the governments have taken the steps to take the migrant workers from the cities to their hometowns. And I think the similar step has to be taken by the governments to bring them back as well. Right. And I believe it is very much required. There is a specific model booster announcements from the government will required to bring them back. That they will government will take care of them, and ensure that they are in a better position placed with companies. So I strongly believe some measures, for the lockdown, Modi ji came and gave speeches to create that impact. In the similar way, to when the to come out of the lockdown also, the government has to take very, very strong measures. And in terms of the communication also has to be very, very significant to make sure that that impact is there, so that people are now completely at home. They have to come out and face COVID and live, start working, and that is what is the requirement at the RS. To be very frank, when I inquire with some of my friends who have been affected with COVID, the youngsters are fairly okay. They're sitting at home and having paracetamol, and they got recovered. Some of them sitting in London, who are managing funds over there. They are also, many of my friends have got impacted, and they've recovered very fast in 10-12 days time. So it's like a flu, nothing to worry per se. But people are, lockdown impact is significant, and the government notifications and all put scare on you that if you go out you will die. So, but that is not the situation at this moment. The most cases which has been reported, the death is that the people who are having some other ailments also getting mixed up, and if you're diabetic, if you're having heart disease, or if you're having kidney failure, then it get aggravated because of the a significant flu coming in. So that is where the problem is, and the numbers which has been reported in US also is in that direction. So my belief is that government has to take some serious measures to communicate very clearly. This is the time to get up from our smooth sitting at home and start working. And if you don't do that, people will die out of hunger more than COVID. And I believe that that is very much required at this point.
Okay. So now the thing is, as you spoke earlier, that the real fiscal stimulus is almost around 1 lakh crore out of the 20 lakh crore which government announced. So, in this context, we can clearly understand the fact that government has done their best as far as what they could do. But the fact remains that the stimulus is on the lower side. So at this point in time, with the constrained resources what we have, and at this point in time, I was reading some of the strategists as well, prominent global strategists, talking about that gold reserves with India is to the extent of 650 ton. And whereas Middle East, if you look at Saudi and all, they have around 250 to 300 ton of gold reserves. So do you see any kind of scenario wherein the gold reserves will come up for distress sell at this point in time to fund the growth which is required? How is it the dynamics going to play out at a time? And I am putting things in context with the fact that a lot of Indians have put their money in gold as well. So how the asset allocation should be considering these all things? And if it is invested in gold, how should one think about it from an asset allocation standpoint?
Right, right. So I think, if you look at the when do people invest in gold? So people invest in gold when you want to have a safe haven status. Basically, you are worried about the currency, commodities, and equities. So that's when people go into precious metals. If you see, the largest asset class in the world is currency, followed by commodities, then comes to bonds, and then equities. So when you see there is a significant improvement in the prices of commodities, you are not going to put money in gold. And if you're seeing the significant improvement in, there is a significant room for the, the sectors like currency going to do well in particular country. Say for example, dollar is going to appreciate against a basket of currencies, then the money will chase dollar, rather than going to gold. So this is what you have to remember, and especially when you want to safeguard your money, that's when people put in debt. So when the debt starts, the GSEC yield start falling, what it means is that people are putting more and more money into GSEC, right? And that is why US GSEC yield went down to 0.5%. And in India also, it went down below 6%, because more and more people are disbelieving other asset classes. They want to safeguard their money, and they're putting the government bonds, which is a sovereign guarantee. Now, when these things change, and a recovery scenario, what I believe is that, all these are going to change. Commodity prices will start inching up. Currency, say for example, INR is in a very, very sweet spot compared to other currencies because we are an importer of crude oil, and also we are importer of many other commodities also. For crude and crude derivatives, it's a very significant chunk in the overall. So today, you would have seen that when the trade deficit number came, it is only $6.76 billion, which is the record low, and it has to be actually recorded as one of the lowest point in history. And I think it is not going to. We are not going to see that kind of record low situation any longer. For that, when you see these kind of situation, we know that the current account situation is very, very robust, which means INR is going to be in appreciating zone going forward, because as current account deficit increases, that's when the INR depreciates, which happens across globally also. The current country where the current account is actually increasing, the INR depreciates. So here the situation is going to be that INR is going to be an appreciating bias. Recently, the INR has depreciated because of the FI pulling out money from debt as well as equity, almost $15 billion in the case of in the month of March. But I think that is going to reverse over a period of time. Money will start coming in, FDI will increase, and also FI money will increase into debt as well as equity. So if you think about that aspect, from specifically from Indian context, you are going to see that INR will have an appreciating bias, and it is not worthwhile considering gold at this point in time as an asset class, because you have to put money when there is a fear among all other asset classes. This is not at a time when recovery is around the corner. Maybe a year's time, you are going to see the recovery is going to happen, and gold price is already showing record high levels. But if you see from a global investor point of view, maybe there's countries where it is depreciating currency situation, where they are producer of commodities, and for them it makes sense to put money into gold, because I think their economy, like be it Middle East or Brazil or Mexico or all these countries, they're Russia, the producer of oil, crude oil, and many other commodities, they will be in a significant stress at this point in time because the prices are falling. For them, as a stopgap arrangement, you can look at the investors can look at investing in gold. But for a country like India, where the recovery is very much possible, and the INR can be in a appreciating trend, gold as an asset class would be the least preferred. Now, the government initiative to buy gold and print money and all those things which is talked about, I don't think it is a very, very easy method, because printing money can be done in a country like US, where their currency is a reserve currency. So therefore, they can print unlimited amount of money and still get away with it. But in INR, if you are having we are a developing economy. It's an emerging economy. We have to invest, and we need capital to attract capital. And then if you start printing money, it can create a very chaotic situation also. So to circumvent the current juncture, I think maybe government borrowing outside and putting money into the hands of people is more important, rather than printing money and creating more chaos against gold or the reserve, the forex reserves what we have. I am not a but today the asset allocation mix should be skewed towards equities, because equity is the best recovery play according to me. Debt, it doesn't seem to be very interesting, because debt as a class, you have to look at when the interest rates are at a peakish scenario. That was almost 3.5 years back. Whereas today you have to put money in the equity for a good recovery play. Debt actually can be in a very tricky situation the next 1 year, when the rating downgrades can be more than rating upgrades. So it is better to be in a safe than sorry. And a lot of impact what is to happen to the company is already visible in the stock prices, but not in the debt prices. So, and debt, obviously, that it is a very illiquid, it's a over-the-counter trades which happens in India. There is no, NSE kind of platform where the trades happen in a very, very transparent manner. So it is always tricky. So to maintain the liquidity and the pricing in the debt market, so you need to be careful while you're investing in debt. Specifically, you have to be in the low end of the yield curve, especially in the short tenor maturities, you need to be invested. Good quality papers and less than 3-year maturity is what I would recommend, and not in gold any longer. And real estate as such, the physical real estate is not cheap even today, especially in the cities.
Okay, perfect. So now coming back to international markets, and at present already the world economies were suffering because of COVID-19 and whatnot. Now the another fear which is coming up is with regards to the announcements by the president of US, that is Donald Trump, talking about trade wars with China, sanctions, whatnot. So in this context, how do you see that trade war is going to have an impact on the economy? And the other important thing is China being disfavored because of the COVID-19 issue and all. How is it going to be a boon or a big positive for Indian companies or the Indian economy? What do you see the silver lining out here?
It is pretty evident to me that the supply chain disruption caused because of big reliance on China has impacted many companies in US and other parts of the world, especially Europe and US, because their base of manufacturing was in China, and the supply disruption has taken them to a significant difficult spot. So I believe that. Post COVID, there will be clear thought from the minds of various entities in US and Europe and other parts of the world that let's de-risk our business model to have one more good manufacturing base where the tax rates are reasonably at the global standards, and also providing a reasonable stability in the government policies, and alongside having very strong conducive environment for the capital to be input also. So if you think from that perspective, India stands a very good chance to get some business out of China, and that is what I would believe in the next 3 years there will be significant increase in the FDI. The starting with what we have seen, the Facebook investing in Reliance, those kind of big investments will happen in India, and that is what I would expect especially in the manufacturing space. There is a good room for, be it pharma API manufacturing or electronics manufacturing. There is a good room for that to do well over the next 3 years. So that brings to the growth prospect scenario for the infra and capital goods segment also. Now coming to, and plus it will create jobs and which will increase the consumption. Now second point is where
Excuse me. Sorry to interrupt. Can you please raise your voice to make it a bit more audible, George?
yeah. So
And
is it audible now?
yes, it's a bit better. Yeah.
Okay. So
Yeah. Please continue.
yeah. So the point is that Donald Trump can make those kind of remarks that we are not going to increase the trade war with China and things like that. Ultimately, I believe that he is a businessman. He want to find ways to get his points get sorted out with China. If you see the yesterday's announcement of Apple moving their manufacturing base to India, the moment that the Apple announced it, the response from Donald Trump was very different. If you want to rake up the China trade war, that was the best time to say that, please move your manufacturing base to India. But what he said instead was, if you move to India, then definitely we are going to increase the tax charge on the company. So what it means is that he is in a negotiating table with China to get some of the points which he wants to get it sorted out. Therefore, I don't see this trade war escalating beyond a point, and it is more of a negotiation and getting things sorted out. Why my expectation is that trade war news and all those things during this post-COVID period is not relevant, because ultimately even China has to fight a big battle. They are also facing significant problem with regard to their banks not having the enough capital, and they're, even though it is sovereign banks, but they have huge NPA issues in their country as well. So they are not in a position to compete against any big country with regard to these issues. So I'm not of a believer that it is going to have a material impact. So nevertheless, the point we have to remember is that these talks and these kind of news flows will create volatility, and you might get dips in the market which you have to utilize to buy into, and wait for next 3 to 5 years to make money in the equity segment. Debt, obviously the upside is limited. Even if you invest in a credit risk fund, taking all kind of risk on credit as well as the interest rate risk, the return that you're going to make is only 10% YTM. So there's no material upside that you will get, rather than the downside is significant if it opens up. So I would say that this trade war and all needs not be much looked into at this point in time.
Okay, now let's take up some questions from our channel partners and investors. First on the line is Mr. Anil Bad. So I'd be asking him to put up a question to you, and let's take him online.
Yeah, sure.
Hello.
Hello.
Yeah, Mr. Anil Kumar Vaid is a chartered accountant and an AP with us for a very long time. So he's with the market since long. So he's going to put up a question to you.
Hello, sir.
Hi, sir. How are you?
Hello. Fine, sir. There is a lot of uncertainty in the market and prediction of recession also. How should investor prepare for the time like this? And what are the investment strategies that you would suggest for next 12 to 18 months?
Sir, I think, every crisis situation, I have come across the same situation in the past. This crisis obviously is very different. It's a medical crisis rather than a financial crisis. Maybe this medical crisis continue, it can lead to a financial crisis. But in 2008 also, I was part of ICICI Prudential Mutual Fund at that point in time. At that time also, the similar tone was there that this is a very, very different crisis. Financial crisis is a once in a 100-year phenomenon, and this is not going to revive very soon. And eventually the liquidities supplied by US government as well as the Fed buying bonds in the market, and there's a massive liquidity supply done at that point in time. And eventually US markets recovered, and then the world market recovered, and economy recovered, and markets also recovered. So I believe that the kind of liquidity pumped in by US, Europe, and other countries are massive. We have tried our bit in terms of pumping in liquidity, but at the same time creating more not direct demand boosting scenarios like what US would have done. Like US has pumped in $2 trillion directly to the money market, which is not what Indian government can do. But nevertheless, Indian government also has done its part. Overall, I believe that this is a time to be very, very positively positioned. This is not the time to be negatively positioned because the valuations are fairly reasonable. I look at valuations, aggregate market valuations, especially from equity standpoint. That you look at the price to book multiple. Today it's at a 2.2 times, whereas on 23rd March 2020 it reached a 1.8 times, which was lower than 2008 October kind of situation where Lehman crisis happened and where market reached. So it was a fairly very attractive scenario in 2020 March 23rd when the market tanked to 7,800 Nifty. So we had put out the article saying that this is not the time to worry, this is the time to invest and be grounded. And if you don't invest, you get these kind of opportunities once in 12 years. 2008 we saw this kind of situation. So every 10 years, as Warren Buffett says, that you get a crisis period, and every 10 years you get a crisis period that you have to utilize well. So when Mr. Warren Buffett came to Delhi, and I had an opportunity to attend his session, what he mentioned very clearly was that we asked, sir, how did you make so much of wealth? So he said every 10 years you get a boom and a bust, and you every boom you keep selling, every bust you keep buying, and just
That's a
be,
wonderful.
and next 10 years you be silent and you make a lot of money. Like 2008, if you had invested, 2017 you exited, and you have made a lot of money, hell lot of money, right? So even in India. So if he said that 5 times I've done the investing and exiting, and I've been sane enough to not to trade too much and be very safe investor, and that has made me rich. So the point I want to highlight is that we are in a situation where the entire economy has tumbled. There is a lot of issues which we can see in front of us. But I'm just thinking 1 year ahead, what will be the situation? 1 year ahead, you might be seeing, as per the IMF forecast. I'm not going by my forecast. In an IMF forecast, it says that 7.4% is the GDP growth for India. GDP is going to grow in 2021-22 at 7.4%, and if 1 year from now you will be seeing that that growth already start happening, right? And 2021 May, when that is exactly 1 year from now, the situation would be that market will start pricing 2021 to 22 growth, right? And therefore, there is the time horizon for you to be worried and not to sit and relax is not even 1 year period. Maybe market is already bottomed out on 23rd March, and maybe that will come to know after 6 months, and maybe it will not go down to that level. Maybe corrections can happen any point in time, little bit here and there, but I think the major correction is over, and you need to position for a recovery. So I will not invest in debt. You need to have some portion in the the most liquid category, be it FD or liquid fund or overnight fund, so that you don't take any credit risk or interest rate risk at this point in time, but be positioned for recovery through equity investments. So I'm very bullish on the small cap as a segment, which people don't like at this point in time. People say that all the companies will go down the drain, but every crisis period, you look at the post-crisis period, even 2009 March to 2010 March, the first year of the recovery, we have seen the small cap segment has given the massive returns, and even 2003 April to 2004 April, the starting period of the bull run, we have seen that the small caps have given the massive return. So you need to have some allocation towards small caps, mid caps, and then large caps. All three categories will do well, but maybe 50% towards large cap and 25% to mid cap and 25% to small cap. That could be a good strategy to have, and that is how we are positioning our funds also in light of this COVID-19 recovery. How to play that recovery, we are thinking that now.
Okay, thank you so much, Anilji, for asking the question.
Thank you, sir.
Yeah. Now the next in our line is Mr. D.D. Jalan. So he is an ex-CFO Vedanta Group. So he would like to put up a question. Yeah, Mr. Jalan, please.
Hi, Mr. George.
Hi, sir.
Mr. George, in this unprecedented situation, how one should think of the equity selection, and particularly from the point of view of how much focus on safety versus how much on the opportunity what market is offering, and also whether it should be the domestic manufacturing sector or export oriented unit, and also when do you think will be the time when one should say that yes, go fully invested rather than keeping some percentage as the liquidity?
All right, sir. So I think it's a very valid question, sir. At this point in time, my belief is that it is very clear in my mind that you have to play the recovery. To play the recovery, the best way, some of the good export-oriented sectors which has been doing very badly, that is the pharmaceutical sector in the last 5 years. And I see there is a silver lining in looking at that sector as a good leading pack for investing, because that can, I see the turnaround in the business cycle itself, and which can propel more money coming to that sector. One, as a defensive, good quality businesses available, good cash-rich businesses. And at the same time, there is a good scope for growth coming in. Ultimately, pharmaceutical industry has to grow for the next 20 years, 30 years in India, as it has happened in in US and Europe. as we move from emerging market to developed market, there is a significant room for the discretionary spending, health awareness, and all those things to happen, and the growth happening in that segment. So the domestic business is safe, and the export business also is now coming back. So there is a good amount of opportunity there. Secondly, if you look at the key sectors which obviously will be part of the recovery is rural-oriented sectors. I think the government is working on. If you look at the MSME segment, all the package or credit guarantee which is being given, it is to boost almost 60 million MSMEs which is there, which is finding it difficult to raise money from the bank, as well as their cost of funding has been very significantly high in the recent period because banks were reluctant to give the money. I think there also significant boost will happen, which is the heart of the economy in that regard. I think there are sectors which are linked to rural plus MSME, which is be it in the banks or other manufacturing sectors, which is very interesting. Third is the construction-oriented sectors, because interest rates are low, and I believe that there is a significant, availability of funds which we'll see as we move forward. And government also kicking off the capex, and state level also. That is an easier way to deploy the migrant laborers. I think there will be more impetus on the push for construction activities, especially starting off with the government, and then I think that sector can be again doing very well. So I think the recovery is the play very clearly. You cannot play defensives, buying HUL or FMCG sectors at this point in time. I think they're obscenely overvalued, and last 10 years they have done their bit, and every 10 years there is a and post crisis period the change in leadership happens. I think the sectors, even some good quality NBFCs, HFCs, I think it is worthwhile considering at this point, because they are trading at ridiculously cheap valuation, which has not happened in the recent past. And banks also, some of the corporate banks which are well capitalized, they obviously they will benefit from the recovery. So I would say if you have a 3-year window, 4-year window, these are the sectors which needs to be part of your portfolio, and it can do very well.
No, fantastic. And at what point of time, Mr. George, one should say that remain fully invested rather than keeping the cash?
Right, sir. So I didn't answer that point. Basically, the way we are telling our investors is that, invest at least 1/3 immediately, because I believe that 23rd March, my gut feel, my hunch is that 23rd March, where market reached 7,800 Nifty, that is a bottom. Maybe I'm wrong, but I don't think it will be, significantly off from that mark, even if the market goes down from here. But my belief is that as we move out of lockdown, the positivity only is going to increase, and more recovery will be visible, be it auto monthly numbers, the tractor numbers, which is coming in, already started recouping. So you will start seeing that that recovery numbers, especially in the discretionary sectors like auto ancillaries kicking off, which will increase the confidence and the morale of people. So I believe that the investors also will come by. If I don't see any reason why from here on market has to significantly tank from these levels, unless otherwise there is a global chaos again, developing. The biggest worry in my mind from a global standpoint is basically because of the debt level, world debt level is significantly higher compared to 2008 levels. You see US debt or Japan debt, Japanese debt is around 350% of their GDP, whereas India debt is around 60% of GDP. So there is a significant debt related issues globally which is happening, and which is reflecting in the stock prices of Credit Suisse or Deutsche Bank also. So below 2008 levels. So I believe that there is a significant amount of that issue which is looming globally. Unless otherwise, if there is a debt default by any country and all can happen, there will be more downside to the current levels. But I believe that 27th March is a fair bottom. The 23rd March is a fair bottom. But the way to approach the whole situation is 1/3 you invest now, and then wait for, if you get a chance to in the next 6 to 9 months, a big sell-off in the markets for some reason or the other, then look at the next 1/3 to invest, and balance 1/3 you keep it when you get all the confirmations, then you invest. So I believe that that is a way to approach, and it is pretty easy to execute also.
Fantastic. Thank you so much, Mr. George.
Thank you.
Thank you, Mr. Jalan. Thank you. Thank you. Now, the next question is from the line of Mr. Sumit Bachawat. Sumit?
Yes, hello.
Can you please switch on your video if possible and ask a question to Mr. George?
Yeah. Yeah.
Yeah, please go ahead with your question.
Yeah. Good afternoon to both of you.
Hi, good afternoon, sir.
Yeah, good.
Yeah. I just would like to know, the last few years we have seen that this market can rise only with the investment portfolio investors. Whenever they have made an investment, our market has appreciated. But why would the FFIs invest in the market where the Nasdaq has given a return of around 46% in last 3 years, and Indian market has given a negative return of 3%? So, and even they invest money in our market, the price cost is so much difference, is so much for them that even they want to exit the market or the particular script or a particular sector, the impact cost is so much. So what do you think the FFI will have come to India and invest in India?
Yeah, so it's a very pertinent question. This is a question people have asked us in 2008 also. All our investors used to ask in 2008 also that $12 billion were pulled out by FIS in 2008, $6 billion from debt and $6 billion from equity. And that time the similar questions were there. When do you think that the money is going to come back, or is it are they exiting for good? And is it do you think that these FIS will come back? By post March 2009, we have seen that massive amount of money came back to Indian markets. When I look at from the why it will happen again is that from an economy standpoint, the demography standpoint, there is no other better country than India. Let's face it, 29 years is the median age of Indians, and almost 1 million people are getting out of colleges every month, and they're a young population. Almost 1/3 population is below almost 65% and above people are below 35 years. So it is like a massive pool of youngsters who can work and create productivity. Whereas if you look at China, it is 10 years ahead of us. 39 years is the median age. If you look at Europe or US, it is a very different scenario. Or Japan, for example, it's a pretty old population. So the situation is that India is, if you look around, you can easily make out that infrastructure is very poor. There is a huge growth prospects in infrastructure if the government initiates those definitive steps. And if you look at the capital is the biggest challenge, which obviously is now becoming much more easier because globally the interest rates are low, and the government can borrow at a much lower rates and bring in money also, or the other countries can support us. So I believe the growth prospects in India is in a phenomenon. So only thing is the last 10 years we are seeing that the point which you mentioned is that Nasdaq has done well and India has not done well. What is absolutely the reason why they will come back in a vengeance? Because the last 10 years, the capex cycle was under severe stress. 2010 was the peak of the capex. All PSU banks, stocks, prices, you could see that there was a peak. November 2010 was the peak of all the PSU banks. And that was the peak of the capex cycle, which started in 2000. 2000 to 2010 was the infra boom, or the capex cycle, and global growth, especially China-led growth, was supportive, and US also was doing well. Now in the last 8 years, US did extremely well. So there, if you see 2011, US job loss situation was more or less the situation like India pre-COVID, right? To 11, almost 11 to 12% was the jobless situation in US. and from there they moved to almost 3% jobless situation, and that is the achievement they did, and the growth was visible in US, and that for all their US markets did extremely well, and especially Nasdaq, which you pointed out, it has all the five big major tech companies like Microsoft, Alphabet, Amazon, and Facebook, and all these companies have become $1 trillion market cap companies, and that is one of the reasons you are seeing that the returns also. But is it going to be a structural return prospects from these levels also? To my mind, it is whenever Economist, the magazine, has reported in their front page, the five companies has reached a $5 trillion market cap. I think that is a very sarcastic way they have put it across on the front page. And to my mind, that leads to think that there is going to be a possible downturn in the Nasdaq also. So if you think the last 9 years did very well for US, 2011 to 2020, and probably we are at the because of the GST, RERA, demonetization, and now COVID, and last 1 year is nothing short of a crisis, right? We saw NBFC crisis, Yes Bank crisis, now COVID crisis, and Carby crisis, or many crises was there in the last 1 year. So we have seen significant amount of downturn in the economy, and alongside you have seen the markets also not doing that great. It is becomes a perfect situation for me as an investor when I think about it, that next 10 years it can be much more brighter than the last 10 years, because the last 10 years returns in Nifty itself is abysmally low compared to its own history. So the corporate earnings were not there. The capital cycle was, going and a grinding halt. And now I think that is going to recover as we move forward, because Indians need infrastructure. Indians need more aspirations. So that is what I would look at, and the FIs see that opportunity, and they will definitely put India on the radar and come back very heavy.
Okay, thank you so much.
One more question I'd like to ask.
Please.
Yes, sir.
Yeah, I just on behalf of my clients, I would just like to know why the Indian rating agencies are always behind the curve. Why they cannot predict what is happening, what is going to happen. Even the companies are going bust, the corporate houses are going bust, the mutual fund houses are having problem. But never the Indian rating agencies have come in front and just alerted the investors that what is going to happen. Be careful. Why it is not perfect?
Yeah, sir, it is a very, very interesting topic. I think, if you look in US also, the Lehman crisis happened mainly because all the crisis of the subprime crisis happened mainly because of the lacuna in the rating agency. If you look at Freddie Mac, and all these agencies have been giving all the collateralized borrowing obligations. They were rating as AAA, so, and they were giving the AAA rating for all the junk bonds also.
Yeah.
And eventually, all went bankrupt, right? And many looking at this rating, many countries like China and various other countries were subscribing to these bonds, and even some of our Indian companies also, like some of the banking sector companies had exposure to these subprime bonds, looking at these ratings. So ratings is always a misnomer. You have to look through the balance sheets, and as an investor, be it at a mutual fund level, what we keep it as a very simple process is that safety, quality, and low leverage is very, very critical for investing. And if you do that, be it in equity or bonds, and keep controlling that emotions and not going for the extra 1 paisa, 2 paisa, returns, you will lose the capital. There is a chance of losing the capital also, especially in debt for that matter. The interest rate, the yield differential between a LFS bond and HDFC bond was not less than, it was lesser than 25 basis, right? And people were chasing that 25 basis points returns because investors ask for it also, right? Investors put money in the funds where it shows higher returns, be it in debt or equity, and they don't realize that risk is also a parcel of investing. So as a fund manager, I always believe that I have to manage risk well rather than managing returns. So if I manage risk well, obviously on a longer run, we will stand tall. So we have a very simple equity investment philosophy framework which we have put in for debt as well as equity. There is SQL, S for margin of safety, Q for quality, and L for low leverage. If you just focus on that, and the last 30 years of my investing, personally also I made wealth only because focused on some of the low leverage companies, invested for long term, and good quality companies. But wherever I've invested in a leverage company, those companies have gone bust or became penny stocks.
Okay. Thank you so much, Sumit. He's a very old AP with us, and SQL is
It was a nice interacting with you.
Thank you. Thank you. Thank
so
you very much.
SQL is a very good idea to imbibe for all of us as well. So I'll also think of it in detail, in depth. Now the next question is from Arpit Jain. Mr. Arpit Jain is the finance head with Marico Southeast Asia. So he would like to put up a question. Please, Mr. Arpit.
Quite insightful.
Mr. Arpit, please, yeah, repeat once again.
Yeah.
And you can switch on your video as well, please.
So actually it says the camera cannot start video.
Okay. Anyways, we will take it that way then.
Yes, sir.
Please.
Okay.
Yeah,
Hi, Mr. Joseph. First of all, thank you so much for taking out your time. It's been a wonderful and insightful session. So let me start by saying a thanks to you.
Thank you.
And thanks to Ashika for organizing this. I think it's been quite insightful and quite educating. A couple of questions, Mr. Joseph. So you've already answered a lot of the questions that I had in my mind. So just one question that I have in my mind is on the startup space in India and also globally. Given the entire lack of liquidity in the market right now, do you see any impact on the startup space because of the lack of liquidity, and also, a lot of the spend moving away from the discretionary spends right now? So what is your take on that? And just another non-related question is this entire, kind of a bandwagon of moving out of India and trying to de-risk your entire manufacturing setup for a lot of European and American countries. So India, Mexico, and Vietnam are some of the countries that are likely to get benefited most out of it. What's your take on this entire thing? Do you think the government has done enough, or what more needs to happen for India to be able to, carve out a larger pie of this entire manufacturing, base in China?
So, very, very, very interesting question. So, I think first and foremost, I believe that startups, obviously the pool of money which has been pumped into these companies have been significant. It's a constant tap open for these companies all along. I think as and when we see the crisis situation, people will pull back on these investments, and therefore further commitments also will maybe pulled out, which can put some of the startups in trouble. But overall, I believe there will be new startups also coming in, because COVID-19, to compare with that, there will be a lot of startups which are looking at, be it technology enablers or the companies which are doing the business currently, changing their business model and recarving it in a different fashion. So there is a reimagining of the business is something which all CEOs have to do. Right, even at ITI Mutual Fund, we have just a 1-year-old mutual fund house, but at the same time, it is backed up by very strong promoters of Sun Pharmaceuticals. Therefore, there is, but we are also reimagining, how we want to have our next 25-year journey. What are the things which we need to do first, so that in the next 5 years, 10 years, we see a lot of white spaces in our industry also. Be it giving honest feedback, or be diligent to investors, and so we are also looking at those opportunities, and this is a white space is only increasing. Right, taking care of investors' money in the nice fashion. So this will be applicable to across industries, and I think that is the opportunity which I see from the new startup space. So there is opportunities also coming in, but at the same time, some of the taps which were open for, like say for example Zomato, or some of these companies which are burning money continuously and not profitable, and they've been or various other startups. You will find difficulty. Be it Paytm, for example, 500 crores every year losses. I am just mentioning a few names which came in my mind, which has which has burned. One ad they have done. They have spent almost 500, 600 crores. Right. So those kind of money will not be available. So
Yeah.
you have to rationalize on that aspect. But at the same time, I think looking at the countries which you mentioned, Vietnam and other places, where I believe the best country to invest would be still India, in my view, because I've been looking at various markets globally also. What I believe is that the opportunity for India, per capita income to grow is significant if we get our acts right. If the government gets their acts right,
Yeah.
RBI gets their acts right, controlling inflation is already done. So if we are able to get the acts right, I think there is a significant amount of economic recovery which we can have in the next 10 years time, 10 or 20 years time. So it is like a game which government has to initiate, and which is clearly visible in our you look at the infrastructure, it can grow berserk in the next 10, 20 years. You can look at all the facilities, be it road, transport, all the facilities, there's immense opportunity there. Be it metros, anyway, that it has kicked off, but, to get it going across India and to reaching the nucleus of commerce, it will take time. So there is a huge opportunity in terms of infrastructure, smart cities, all those things government announced. There's three projects which has to be initiated. I believe that unorganized to organized shift is happening. That is the initiative which they started in 2016 by demonetization. And the thread which I see across activities of government is that unorganized to organized shift has to happen, and therefore it is a big benefit for the listed space, because if you look at, just take an example of ITC, for example, they have garnered almost 15% market share in biscuits. Yes, and even in the premium category biscuits, they have 40% market share. But if you look at the other big players in biscuits, they have not lost market share, right? So be it Britannia or Parle, they have not lost, which suggests that they have taken market share from the smaller ones, the unorganized segment, and they're able to grow and create a business out of it. So there is a huge opportunity which is coming on our way in terms of, especially for the listed players, to grow and scale up. And the unorganized businesses in India, which is contributing almost 50% of GDP, that's where the disruption has happened massively, and where I see the opportunity lies. Like, say, for example, Marico, when they're coming up with the new initiatives and all those things, I believe that there's an immense opportunity for them also to take market share, especially homegrown brands, to grow and scale up. There is a huge opportunity. So from a next 10-year perspective, if I'm a global fund manager and investor, I would definitely put money in India rather than putting anywhere else, because the demography is very strong. We are we are a user of commodities rather than producer of commodities, which are all very, very nice situations to have. And current account deficit is under control. External debt is under control, which is one of the lowest, compared to all other developing countries. So we are in a sweet spot, and FDI money will come significantly. And maybe Donald Trump can make noises saying that you don't go to India and be in China and all those things. But it's up to the companies to decide whether which one, how to de-risk their business model, whether they want to be fully reliant on China. I think with the taxation also being reduced, and more positive government reforms coming in, and very stable government in place, I think that is 4 years yet to go for Modi government. I think there is a very, very positive impact which can create to various counterparts who are evaluating India as one destination of manufacturing. I think manufacturing share India will get. I mean, I was talking to some of my group companies, and what I sense is that even for manufacturing of pharma and APIs, there's significant inquiries which has come in, and people are so it is definitely taking place as we speak.
Great. Thank you so much, Mr. Arpijan. He is sitting there in Vietnam, I think. So he's at the heart of one of the places which is widely talked about,
Yeah.
as far as disfavoring China and coming to India or Vietnam or any other places in the Asian countries is concerned. Thank you so much. So
Thanks.
now
Thanks.
I'll take up one more question which has come to me via WhatsApp, and many of the questions were there lined up, but almost all have been answered one way or the other. That was from Mr. Neelam Sharma, Mr. Naresh Mukherjee is our AP, Mr. Rajesh Ghosh. So I think they have been answered. One question from Mr. Porinjit Shah, he's an HNI. And then we will conclude finally. His question is, many are suggesting to get into longer term debt funds of 3 years or maturity to lock in the current interest rate. What is your view on the same? Should one go for long term or short term of less than 1 year in the present scenario?
So, in terms of the taxation definition, he is mentioning about long term, but otherwise, long term as per the definition of SEBI is very different. It is 7 year and above. So, from a taxation point of view, I agree that in long term taxation, long term capital gains is applicable to 3 year maturity papers. I would, I would agree with his thought. I think if at all you want to park money in debt at this point in time, when the interest rates are very low, this is not the time to park money into long duration bonds. When I say long duration bonds, is more than 3 year maturity papers. You have to invest into short duration bonds. So short duration bonds is what is classified under less than 3 year maturity papers, and that is where you should park your money. My bet is that the liquidity also is very significantly high in the banking system, which is benefits the short duration bonds rather than the long duration bonds. So I believe if you want to park money less than 3 year maturity papers, the thought is right. You should invest less than 3 year maturity papers, and maybe ultra short term and long and 3 year PSU banking funds could be considered as the investment opportunity. Overnight funds, liquid funds also is an option if you don't think too much about the interest rate. You know, the way I look at debt is always that debt, the upside is limited. So if at all we want to play recovery, you have to put some money into the equity markets. So I would be more inclined to suggest all the viewers and investors to look at equity as an asset class with a 3 to 5 year window, and I think that is the opportunity definitely in front of us. Rather than investing in debt and maybe 1%, 2% here and there you might make, but that is not relevant at this point in time.
Great. Now, I would conclude by saying that when you hit the rock bottom, the only way is the up way. So here the question lies is whether the economy has made a bottom or the market has made a bottom. That is a debate one needs to make. But as Newton says that it is very difficult to understand the psyche of the people at this point in time in the short term, what can happen, but easy to measure the motion of heavenly bodies. So I'll conclude by saying that. And thank you so much, Mr. George, for enriching us with so much of wide variety of topics we have discussed today. And that certainly is going to help the investors and all our channel partners and all to take informed decisions. Thank you so much.
Thank you. Thank you so much, Anderson. Nice interacting with you.